Our next paper will be The Fiscal and Monetary Response to COVID-19, What the Great Depression Has and Hasn't Taught Us, by George Selgin. Take it away, George.
Thank you, Chris. Can you all hear me? Can you all hear me? Good.
Yes, perfect.
Thank you, Chris, and Tim, Juan, for putting this conference together and for inviting me to be part of such a distinguished crowd of economists. I've been asked to talk about the Great Depression policies and to make some comparison between them and the policies that have been used to deal with the current crisis. And so my talk makes for a natural follow-up, I think, to Bob's. There's one difference. First of all, the Great Depression is always attempting a standard of comparison for all other depressions, most obviously because people see it as a gauge of just how bad any subsequent depression is. Right, all other depressions are trying to be as bad as the Great Depression was. So far, thank goodness, none of them has broken its record. But there's another sense in which the Great Depression, or more specifically the New Deal, has been treated as a standard. Some have treated it as a standard of how the government should respond to a major crisis. For example, at the beginning of the present crisis, Harvard American Studies professor Elizabeth Cohen wrote, "The New Deal remains the standard for how the federal government should respond to a national emergency." So I'm thinking about that quote, and I want to look into the response of the New Deal to the Great Depression, and then compare that response to the present response to the COVID-19 crisis, and ask what should we have learned, what could we have learned from the Great Depression, and what haven't we learned that perhaps we should have. So, Kobe, if I could have the first slide, please, I'll begin. And I'm seeing the little slide, so let me see if I can, there we go. I want to start, first of all, by noting that although superficially the present crisis does have some things in common with the Great Depression, particularly its initial severity. It's a very, very sharp, deep recession as by conventional measures. We should keep in mind the very important differences, some of which are quite obvious, between the present crisis and that of the 1930s. Most obviously, I think, the crisis of the 30s involved, in a very important way, a financial crisis. And that was, of course, also true for some other financial crisis, for some other past recessions, like that of 2008. This is very important because it suggests immediately some respects in which the actions taken to address the crisis of the 30s are not relevant today. Since we didn't have a financial crisis, we don't need to learn from the things that the government did both under Hoover and Roosevelt to deal with the banking crisis. Our banks are actually relatively sound, and that's a good thing, because it means that the collapse of spending is actually a lot less serious than it might have been had it also been accompanied by a major collapse of the banking system. The other thing that implies, that this difference implies, is that we don't have as strong a reason to suppose the present crisis will continue for a long time, because although it's not always true, as Mike Bordo has shown, it's often true that when recessions or depressions involve major financial system collapses, the recovery can be much more protracted, as indeed it was in the case of the 1930s and in 2008. Finally, talking about differences in policies, as I'll make more clear later on, some of the most important things that were done to address the Great Depression involved tampering with the gold standard and ultimately devaluing the dollar in terms of gold. Obviously, those steps are not ones we can resort to today, having suspended the convertibility of dollars into gold completely some time ago. We can't do that again. So there are only so many lessons, but there are some lessons and important ones that I think we can draw, and some that we have drawn from the episode of the 1930s, lessons that are applicable today. If we could turn to the next slide, Kobe, this I just want to make clear that we are in fact already seeing considerable signs of recovery from this crisis. So once again, the difference between it and the Great Depression is in this respect marked. This is a somewhat old slide, but if anything, the pace of recovery has exceeded what was anticipated here and shown most clearly with the yellow line and the dotted line underneath it. So recovery has certainly not been very slow so far, and of course we can only hope that that it continues apace. Now I'm going to turn right away to the question of fiscal policy. I want to take up that subject, but I first want to say that when it comes to fiscal policy and also monetary policy, I'm going to argue that the lessons from the Great Depression are mostly negative lessons. It's more an example of what didn't happen, what the government didn't do, than of what it did do. And to that extent, in a sense, we have learned a lot from the Great Depression, but we've learned only in the sense that the government has done a lot more now in both monetary and fiscal policy than it did in the past. So it hasn't learned in the sense that it's copying what happened under during the New Deal. Let's go to the next slide, and I can begin to show you what I mean by that. This is a slide showing the extent of government spending during the 30s, and it shows both total government spending, which is the red line, and the purple line. Sorry, the blue line shows the deficit. And finally, the purple line shows what's happening to real GNP, that is starting from a value of 0. And the point of this chart is to say that both total government expenditures and even more so deficits were very small back then as a proportion, not just of total GDP or GNP, but with respect to the change in the decline in GDP or GNP starting from 1929. So we didn't have, by today's standards, we certainly didn't have a very aggressive fiscal policy response. We had a lot of programs. There were all kinds of alphabet programs, and relative to the past, to the 1920s, government certainly did grow and deficits did grow, but they were small by modern standards. And indeed, the New Deal did not increase the deficits or levels of government spending all that much compared to the later years of that is the post-Depression years of the Hoover administration. Finally, it should be pointed out that the deficits in both administrations were, until 1938 or so, 37, 38, the deficits were mainly inadvertent. That is, neither administration, Hoover's nor Roosevelt's, was really trying to engage in deficit spending along what we today might call Keynesian lines. Rather, the deficits were simply a result of declining revenues and the government's inability to make them up with new taxes, although they certainly tried. Kobe, if we could switch to the next slide. This slide it gives you a little bit more of a sense of the size of expenditures and the surplus, or in this case, deficit spending. Again, looking back towards the beginning, from the beginning of the Depression, there's only really 1 year here where there's a really big deficit, and that's 1936, and that's because of bonus payments to the Army, which Congress approved over a veto by FDR. So he was not intending to have such a large deficit that year, but Congress had its way. So otherwise, fiscal policy is more of a story of the dog that didn't bark than anything else. And I think there are very widespread misconceptions about this today, where people still look back to the Great Depression as a period when the government really knew how to use aggressively expansionary fiscal policy, whereas in fact they were mere pikers compared to our governments today. In fact, in normal times, government spending today is a much bigger share of GDP than it was at any time during the New Deal. Now let's take a look a little bit at the fiscal response to the recent crisis. Kobe, if you could advance another slide here. Now, these slides aren't quite comparable. This one shows what's been happening to government outlays or expenditures and to revenues as a percentage of GDP. And as you can see, we've spiked up to over 30, close to 33, 34% of GDP in government spending after the outbreak of the crisis. This is expected to go down and then start rising again, mostly because of the interest payment on what will be a much larger federal debt. Now, 33% of GDP, now you're talking. That's closer to the level seen in World War II, which was a record of a 44% government spending to GDP, than to the much more meager levels of spending seen during any time in the 1930s. If we can go on to the next slide, Kobe, thanks. And here you can see what some of the composition of spending today is. And obviously, there's a big component of discretionary spending that's going into the spike, mainly. And then the rising spending afterwards is mostly the trend in total spending by the government afterwards is mostly a result of expected growth of net interest payments for servicing the government debt. In any event, we're seeing a level of spending, a fiscal response to the present crisis that's many orders of magnitude greater than what took place during the Great Depression. So the New Deal has nothing to teach the present administration about aggressive fiscal policy. Nothing at all, really. This aggressive fiscal response does seem to have borne some macroeconomic recovery fruit. If we could look at the next slide, Kobe, we can see this. This is a slide showing total spending, not government spending. This is total spending in the economy. And of course, you can see the terrible collapse that took place in the spring of this year, followed by a gradual recovery. This is in the growth rate of spending that has recovered largely. It's still 2.3%. Total spending is still 3.2% lower than it was before the crisis. So we haven't quite recovered the rate of spending, and we have a substantial deviation from the trend in the level of spending that has yet to be made up. And it presumably a lot of what we're seeing here, or a significant amount of it, is a result of fiscal policy, particularly the payment of unemployment benefits, which allowed workers who were unemployed, of course, to keep on spending. And these benefits were very generous even compared to ordinary unemployment benefits. They do raise a problem, and that problem is whether when these benefits run out, the unemployed are able to, will in fact have to retrench their spending once again. But two forces are kind of maybe balancing each other out. As we recover from the crisis and restrictions are relaxed, pent-up savings by those who've kept employed, and there have been a lot of so-called forced savings, as others have mentioned earlier today, those will come out of hiding and contribute to the total flow of spending, at the same time as spending by the unemployed may have to retrench unless we have a new benefit package come out. But until it does, those who don't have jobs, and their numbers, of course, have been falling rapidly, still, they may not be spending as much as they could or were spending while they were receiving benefits. I'm going to skip a section, Kobe, if you don't mind. I'd like to skip ahead. If you will skip ahead and to the slide that comes right after the one with the Kennedy Center on it, in case you know what that looks like. It's a pretty building. One more, and the next is going to be the right one. Very good. I'm skipping a section because I'll probably run out if I don't, and turning straight to talk about monetary policy. And here, I think when we talk about Federal Reserve policy in the Depression, either monetary policy or what I'll call credit policy, which is mainly bank lending policy, once again, the lessons are mostly negative. It's mostly not about what the Fed did, but what it didn't do, and the difference couldn't be more stark. The difference between the 30s and the New Deal and today can almost be summarized as a difference between doing next to nothing, which is what happened in the New Deal, and doing a hell of a lot. Now, this first slide you'll all recognize, of course, as the Fed assets as they've evolved since 2008, and what happened, and again, as most of you know, is that we saw a quadrupling of the size of the Fed's balance sheet in the course of the 2008 crisis until it reached a level of just over $4 trillion. And now, in a very short span of time, the Fed has added another $3 trillion. And this is all from quantitative easing, that is, buying assets, long-term assets in this case, on the open market. Let's just set that as a background, and let's turn to the next slide where we look at what happened in the Great Depression. Oh, where'd that come from? Did we skip something? I have a different slide. Well, go ahead. Let's see this next slide again. I must say something relevant. That shows interest rates. I think somehow that got put out of order, but that's all right. I can deal with it. It's in different order than in my paper, and I bet you the person responsible is a real idiot, which would be me. This chart shows something that the two episodes both have in common. Interest rates were very, very low in both episodes, and people may not realize just how low they were in the 1930s. This shows Treasury bill rates, and you can see that they were a little higher in the first half of the Depression, but eventually they dropped down to next to nothing. This slide is actually useful as background for the next slide, because it helps to explain why Fed authorities didn't expand the monetary base back in the 30s by engaging in open market operations the way we did. So let's go ahead to the next slide. 1 minute. Oh, okay. The big fear in the 20s was that the Fed would be pushing on the string with interest rates so low. The banks would just accumulate reserves. And if we look at the next slide, Kobe, we can see this. Excess reserves were rising very quickly, not because of Fed open market operations, but because gold was flowing into the system And the fear was that this would lead to inflation. So not only did the Fed not buy any, engage in any open market purchases, but it and the Treasury responded to the accumulation of excess reserves in the system by trying to head off inflation. In a way, this is a little bit like, this is Bob, this is anticipating, right? And they anticipated too much in this case. They doubled reserve requirements at the Fed, and the Treasury sterilized gold flows, all in the name of anticipating inflation that, of course, never came. Instead, you got the very serious reserve collapse of the very serious collapse of 1937-38. I've got to wrap up without having gone into credit policy, which was the next area that I wanted to talk about. But I'll just say very quickly that the Fed also did very little in the way of credit policy or direct lending in the 1930s. It didn't even lend much to banks. The RFC, on the other hand, which was created by Hoover, did engage in other kinds of lending. But if you look at credit policy of the Fed today, it overshadows by far the lending of all kinds done by both the Fed itself in the 30s and the RFC. So here again, the response of the government today, including the Fed, is much, much more aggressive than anything seen in the 1930s. Well, I don't have time to talk about inflation policy today, but others have covered it very well, so I guess I'll wrap up now. Thanks very much for your attention.